Before Warren Buffett became known as the Oracle of Omaha, he was just a curious boy from Nebraska with an obsession for numbers and a deep fascination with the way money moves. While most children spent their days in playgrounds or glued to comic books, young Warren devoured financial reports and business magazines like they were treasure maps. His mind was wired for investing from the beginning, and what followed would become one of the most astonishing wealth-building journeys in human history. Warren Buffett's story begins not in boardrooms or on Wall Street, but during the Great Depression. Born in August 1930, right after the economic collapse rocked America, Buffett's early years were defined by scarcity and frugality. Watching his family navigate financial hardship made a powerful impression on the young boy. He understood that money wasn't just important. It was the difference between survival and struggle. His father, Howard Buffett, had been laid off from a local bank, but instead of accepting defeat, he took a bold step. He opened a brokerage firm. That decision not only kept the family afloat, but planted the first seeds of Warren's fascination with finance. He spent hours at his father's office, surrounded by stock tickers and trading chatter, absorbing every bit of knowledge he could. By the age of 6, Warren launched his first business, with bottles of Coca-Cola in hand. He knocked on doors around his neighborhood, selling the beverage for a small profit. It wasn't about the soda, it was about the game. He understood the concept of margins long before most adults ever did. Before his teenage years, he was also selling chewing gum, delivering newspapers, and even running his own pinball machine enterprise. At just 11 years old, Buffett made his first stock purchase, 3 shares of City Service preferred at $38.25 each. Not long after, the shares dropped to $27. He held on, nervously watching the numbers. When they climbed to $40, he sold. He had made a small profit, but not long after selling, those same shares soared above $200. That moment left a mark on him. He later reflected that the experience taught him the value of patience, a lesson he would carry for life. Throughout his youth, Buffett was awkward, shy, and introverted. But when it came to money, he was confident. He read everything he could get his hands on about business and investing, including a life-changing book, 1,000 Ways to Make $1,000. That title might sound outdated today, but to Warren, it was a blueprint. His determination led him to pursue higher education. He began at the University of Pennsylvania, but later transferred to the University of Nebraska. After earning his degree, he applied to Harvard Business School and was rejected. At the time, it felt like a crushing blow. But as fate would have it, this rejection redirected him to Columbia Business School, where he met his greatest mentor, Benjamin Graham. Graham was a pioneer of value investing, and his teachings would shape Buffett's entire investment philosophy. Buffett didn't just read Graham's Intelligent Investor. He absorbed it. Graham believed that the stock market was there to serve you, not guide you. He emphasized the importance of intrinsic value, margin of safety, and discipline. After graduating, Buffett worked for Graham's firm in New York. It was there that he mastered the art of security analysis. But it also became clear that Buffett had ideas of his own. While Graham focused strictly on numbers, Buffett believed that qualitative factors, like brand strength, leadership, and long-term vision, also mattered. Eventually, Graham retired and shut down his firm. Buffett returned to Omaha and, in 1956, launched his own investment partnership with just over $100,000, pooled from friends and family. He ran the entire operation from his home, refusing to spend on office space or staff. It wasn't about appearances. It was about results. In the early years, Buffett adopted what he called cigar but strategy. He would look for companies that were undervalued, sometimes so deeply that their liquidation value exceeded their market cap. These businesses were often unglamorous, even on the brink of failure, but they had one last puff of value left in them. And that puff for Buffett was pure profit. By the mid-1960s, Buffett had transformed that modest partnership into a fund worth millions. His investors saw annual returns averaging nearly 30% and word spread. Yet despite the success, Buffett remained cautious. He often warned against market euphoria. Be fearful when others are greedy, and greedy when others are fearful, he advised. He proved this principle in action during turbulent markets. As the bull market of the late 1960s overheated, Buffett recognized that opportunities were drying up. Stock prices had become too inflated for his taste. So in 1969, he shocked everyone by dissolving his partnership. He returned the capital to his investors and walked away. But he wasn't done, not even close. Buffett had begun acquiring shares in a failing textile company called Berkshire Hathaway. It was another cigar but play. The company was trading below its asset value, and Buffett believed he could squeeze some value out of it. However, after a dispute with the company's management, he took control and made a pivot. He used Berkshire Hathaway as a holding company for future investments. This was the beginning of a financial empire. What followed was a shift in Buffett's strategy, influenced in part by his business partner Charlie Munger. Munger convinced him that it was better to buy a great company at a fair price than a fair company at a great price. This idea became central to Buffett's later successes, to be continued in Part 2. Too often, we get lost in the noise of trending stocks and fast-moving markets. But stories like Buffett's remind us that consistency, patience, and timeless principles often outperform the hype. If this story brought you value, I invite you to share your thoughts in the comments below. What lesson stood out to you most? And while you're here, consider giving the video a like or sharing it with someone who needs a dose of long-term wisdom. Buffett's decision to dissolve his partnership in 1969 was both bold and insightful. Rather than chasing returns in an overvalued market, he recognized that the opportunities for a high-margin cigar but investing had diminished. His move to dissolve the firm showed a kind of foresight most investors ignore. He didn't just follow the numbers. He trusted his principles. This wasn't the end of his investing career, though. It was the beginning of a different, more sophisticated chapter that would cement his legacy. Warren had already made one crucial move before the dissolution, acquiring a struggling textile company called Berkshire Hathaway. Initially, it was another cigar, but a company trading below its liquidation value. But when management reneged on a deal, Buffett responded in an unexpected way. He bought a controlling interest, fired a manager, and inherited a dying business. Most investors would have walked away. Buffett turned it into an opportunity. Berkshire Hathaway became his investment vehicle, a structure through which he could acquire entire businesses or large equity positions. But this pivot came with a philosophical evolution. Influenced by Charlie Munger, Buffett began to prioritize quality over mere value. Munger's mantra, "Buy wonderful businesses at fair prices," resonated with Buffett's evolving understanding of long-term growth. The duo abandoned the idea of squeezing value from failing companies and started searching for durable moats and reliable management. Buffett didn't just want a deal, he wanted a dynasty. And that meant putting capital into companies that could grow for decades. One of the most vivid examples of this new approach was his investment in the Washington Post. Despite being a media company in uncertain times, it had a strong brand, loyal readers, and a clear competitive edge. Buffett knew Katharine Graham, the publisher, personally and admired her leadership. He wasn't just buying into paper and ink. He was investing in a vision, in editorial integrity, in an institution that meant something to millions. This emotional layer, rarely discussed in finance, is key to understanding Buffett. He doesn't just invest in numbers. He invests in people and principles. Buffett's foray into the insurance industry was another masterstroke. Most investors see insurance companies as complex, risk-heavy businesses. Buffett saw them as engines of capital. Through companies like National Indemnity and Geico, he gained access to enormous pools afloat, money collected in premiums that could be invested until claims needed to be paid. This was effectively interest-free leverage. Think about it. Most investors work with their own money. Buffett was now working with other people's money, legally, ethically, and strategically. With billions of dollars at his disposal, he could act fast when opportunities arose, buying whole companies or taking substantial equity stakes in firms like Coca-Cola, American Express, and later, Apple. The Coca-Cola investment is legendary, not just for returns, but for what it symbolized. Buffett bought more than a beverage company. He bought a global icon. He saw that Coca-Cola had something other brands couldn't replicate: cultural ubiquity. The company's moat wasn't just in its recipe, but in its emotional connection with people across continents. Buffett always said he liked simple businesses he could understand. What's simpler and more global than Coca-Cola. By the early 1990s, Berkshire's stock price was growing at a staggering rate. The Class A shares eventually surpassed $10,000, then $100,000, then $300,000. All the while, Buffett stayed grounded. He didn't build lavish offices or buy sports teams. He remained in Omaha, driving modest cars, eating at McDonald's, and reading company reports. The man worth billions lived like someone who understood the diminishing returns of luxury. Buffett's partnership with Charlie Munger matured into one of the most admired collaborations in the world of finance. Where Buffett provided calm rationality and immense discipline, Munger brought sharp insight and philosophical depth. Together, they refined Berkshire Hathaway into a conglomerate like no other. It wasn't just a stock, it was a belief system. It rewarded patience, demanded integrity, and discouraged speculation. While others scrambled for quarterly profits, Buffett looked decades ahead. His secret wasn't timing the market. It was staying in it. His success wasn't fueled by frantic buying and selling. It was rooted in consistency. And that's perhaps Buffett's most profound lesson, the power of consistency. He kept investing. He kept learning. He kept ignoring the noise. And he kept winning. What stands out most in Buffett's story isn't just the wealth he accumulated. It's how predictable that journey was in hindsight. His tools, compounding patience, ethics, are available to anyone, but few use them. Why? Because they require something rare in the modern age: restraint. If Buffett's life teaches us anything, it's this: wealth is built quietly, not through flashes of brilliance, but through long stretches of disciplined action. And it's worth asking, what small action can you take today, consistently for the next 10 years? You might be surprised how far it gets you. When you reflect on Buffett's path, what habits or mindsets stand out the most? I'd love to hear your perspective. Share your thoughts below. And if this message resonated with you, consider sending it to someone who needs a reminder of what true wealth building looks like. Berkshire Hathaway's evolution into a financial powerhouse was just the beginning of a deeper transformation in Buffett's approach to business. While his earlier investments focused on finding undervalued companies and unlocking hidden value, the new era saw Buffett taking control of entire businesses. He wasn't just a shareholder anymore. He became a business owner. Buffett understood that owning a company outright allowed for a deeper influence on culture, leadership, and capital allocation. It allowed him to shape the organization in line with his core principles: honesty, frugality, and long-term thinking. He knew that great investments weren't found solely on spreadsheets. They lived and breathed through real people and real work. One of his most iconic moves was acquiring wholly owned subsidiaries under Berkshire's umbrella. From BNSF Railway to Dairy Queen, from See's Candies to Precision Cast Parts, Buffett built a portfolio of companies that generate real cash flow, serve millions, and endure through market cycles. He wasn't just building wealth. He was building permanence. Buffett's genius also lay in what he avoided. He consistently turned away from hype-driven fads, speculative tech bubbles, and aggressive leverage. During the dot-com boom of the late 1990s, when investors poured billions into unprofitable internet startups, Buffett was widely criticized for not joining the party. Pundits called him outdated, too old-fashioned for the new economy. But Buffett remained unmoved. He simply didn't understand how those businesses made money, and if he couldn't explain the business to a fifth grader, he wouldn't invest. Then came the crash. Dot-com stocks plummeted, fortunes evaporated, and Buffett once again stood out. Not because he won, but because he didn't lose. His refusal to compromise on fundamentals insulated him from disaster. In 2008, during one of the worst financial crises in modern history, Buffett made another defining move. As the world panicked and markets collapsed, he deployed billions into blue-chip companies like Goldman Sachs and Bank of America. These were calculated risks, but they reflected his core belief: when everyone else is fearful, the best opportunities emerge. That same year, Buffett penned a now-famous op-ed in the New York Times titled, "By American, I Am." The message was clear: stay the course. Even in chaos, smart investing requires calm. And while many investors seek complex strategies and algorithms, Buffett's approach remains elegantly simple. Buy businesses you understand. Pay a fair price. Let compounding do its work. And above all, be patient. In the years since, Buffett's influence has only grown. His annual letters to shareholders are studied like scripture by investors around the world. His wit, wisdom, and humility have made him not just a billionaire, but a beloved teacher. It's easy to admire Buffett's wealth, but perhaps what's more admirable is his consistency in values. A life lived not in pursuit of extravagance, but of excellence. Have you ever considered what consistent habits, applied patiently over time, could do for your own life? Drop a comment with your reflections, and let's spark a meaningful discussion on what wealth truly means.